So, good morning, bonjour, bienvenue à Paris, welcome to Paris. And let me say it's a great pleasure for Kathleen Stephansen and myself to welcome you at what is the 12th GIC Central Bank Conference in Paris. Kathleen, it's the 12th, but it's an extraordinary one because it's the first we organize after COVID, and it's still better to see each other in person. The last one was 4 years ago, 2018. It's also a bit extraordinary because you are not in the Banque de France this morning, you are in the Louvre, in this auditorium. The Banque de France main premises are just a 5-minute walk away from the Louvre. I am confident that you will appreciate the decorum of the greatest museum in the world. And let me say some words, not about economics to start with, but about this unique place. This museum was created in 1793 in the wake of the French Revolution. And this initiative was, of course, highly symbolic. Prior to its transformation into a museum, the Louvre had been a royal palace for several centuries. It was initially built as a fortress in the late 12th century upon a decision made by King Philip Auguste, who feared, I am serious, he feared at that time an invasion by our British neighbors. It happened. And therefore, he wished to protect the west side of Paris. You are now in the heart, in the core of Paris, but at that time, the city was far smaller than today. The Louvre became a royal palace in the 14th century under King Charles V, and it was enlarged in the course of the 17th century under the impetus, among others, of Louis XIV. I don't know if you are familiar with our enumeration. Louis XIV is our most famous king, the Sun King, the one of Versailles. But he lived, by the way, here in the Louvre before Versailles. Nowadays, you can admire portraits of French kings in the museum. Mona Lisa, obviously, who was not a French queen, and other masterpieces from the Italian Renaissance are far from being the only interesting fine arts to see in the Louvre. And there is also modern architecture. You entered through this so famous pyramid by Pei, which is also a pride of Paris and of the Louvre. I will stop here this very short historical introduction. You can perhaps draw 2 lessons from it. First, each lasting success is a delicate cocktail mix of time, continuity, and disruptions, in our case, revolutions. And second, the Banque de France is almost as old as the museum here. The Banque de France was created in 1800, so 7 years later than the Louvre. So monetary policy came slightly after cultural policy, but there are elements of art rather than science also in monetary policy. We will discuss it today. Let us get back to our conference. I will now leave the floor to Kathleen, who, by the way, speaks perfectly French, but she will introduce in English the hot topics to be discussed throughout the day. I wish you a good conference.
Thank you so much, and welcome to all of you. My name is Kathleen Stephansen, and I'm the Chair Emerita of the GIC, the Global Interdependence Center. And I first would like to thank the governor and the bank for inviting us to, as you all know, an extraordinary setting. The GIC and the Banque de France have had a very long friendship, and it is no coincidence that we at the GIC wanted to make this first in-person, post-COVID international event here in Paris. So thank you, Governor, for making this happening. As the Governor pointed out, our agenda covers a whole range of topics, as you have seen on the program, as challenges abound. And given that the GIC central focus is on issues of global interdependence, I wanted to say a few words on globalization. Because since the Great Recession, the traditional view of globalization, notably that global growth has lifted many out of poverty, that the global economy is not a zero-sum game, that view has been challenged over the years. One challenge is that globalization is not concerned with increasingly skewed income and wealth distribution. A more populist narrative argues that globalization benefits the workers in emerging markets, but at the expense of workers in developed countries, hence the anti-immigration sentiment, the emergence of trade wars and tariffs. And then there is yet another view that sees the closing of the economic gap, say, between China and the US, as a national security threat. And of course, over the last 2 years, two global shocks, as you well know, have an even more serious, if not existential, challenge to globalization the way we know it. The COVID pandemic, and we can also throw in, and it's not throwing in a demeaning sense, the climate change events, but the global pandemic has revealed stark tensions between two opposing dynamics. On the one hand, the imperative need for global collaboration, and on the other hand, the vulnerability of the global supply chain model, which of course pushes back into reshoring efforts. And of course, on the geopolitical front, the Russian war on Ukraine has revealed, aside from the enormous human tragedy, the emergence of new alliances, China and Russia, and has triggered swift and strong sanctions from the West not without adverse effects on the West. It has also triggered a deepening of trade and supply disruptions for commodities, rising protectionism, mounting inflation, and intensifies risk of economic recession and even financial instability. So the long-term consequences of these shocks are unclear, and so is the resolution. But lingering divisive tensions tend to erode the faith in post-World War II multilateral institutions, rendering the ground fertile for major political and trade fragmentation at the global level, which is an outcome that we would like to avoid. It is, of course, also an enormously important moment for the European Union. And that, of course, puts tremendous pressure on policymaking. And that is why I would stop here and turn the podium back to the governor. Thank you very much.
So I don't say good morning again, but I will go straight forward to my topic today about the economic situation and normalization of monetary policy in the euro area. Europe is obviously facing an historic turning point with the Russian aggression against the democratic state of Ukraine. And let me stress once more how unwarranted and shocking this aggression is and how solidary we are with the Ukrainian people. By the way, we welcomed in the General Council under Christine Lagarde's presidency last Wednesday, 2 days ago, the Ukrainian governor, and it was an impressive event. Today, I will focus on the economic consequences of the youth war. They are maximal in Russia, with a GDP fall expected this year of -8.5%, according to the IMF. But these economic consequences are also sizable in Europe. More inflation, less growth, and above all, more uncertainty. And you see here on this year, 2022, it's quite impressive. The change of forecast starting early 21 about this year for growth in blue and for inflation in red. Really, it's striking, especially after February 24th, invasion of Ukraine. It's also impressive on both sides of the Atlantic. That said, we shouldn't, at this stage, rush to the stagflation conclusion. The carryover in growth for the euro area this year is already 2.1% at the end of Q1, after an actual growth rate of 5.4% last year. Unemployment is at a historically low level of 6.8% in March, unprecedented during the whole history of the euro. But admittedly, these are rough waters that monetary policy is currently navigating. And some allege an impossible dilemma between fighting excessive inflation and escaping recession. Let me elaborate against this view this morning. There are arguments in principle against this alleged dilemma. Legally, our ECB mandate clearly prioritizes price stability. Politically, our fellow citizens care first and foremost about inflation and its impact on purchasing power. And still more economically, entrenched inflation would mean less confidence, higher risk premia, and greater price distortion, hence less long-term growth. But today I will not discuss in principle. I will discuss from the operational standpoint about the journey toward normalization of our monetary policy. This journey is delicate, yes, but I am confident that we can successfully manage it. We have already clarified its first part. In December last year, we agreed to phase out net purchases under the PEP, which has now smoothly ended. And at our March and April meetings, we decided to wind down the monthly net purchases under the APP and to end them in the third quarter. What I want to do now with you is to take a broader view of the journey. Let me share this morning some personal reflections about a possible roadmap to help us arrive at the right destination. And they can be summarized into 3 rules of travel, which I will elaborate upon. First, this journey is a fully warranted normalization, but not a tightening so far. Second, the pace and the length of the journey will be guided by an active use of optionality and gradualism. And third, the journey should prevent unwarranted fragmentation among travelers. By the way, I will speak today about travelers and not about birds. You see what I mean? I never believed in the ornithological taxonomy, still less today, describing our discussion as the hawks taking control or the doves resisting. It's a bit of intellectual laziness. It's not about that. It's about a new, challenging situation faced by 25 independent and open-minded Council members, whose views are presently significantly converging. I also stress that. Keynes rightly said, when facts change, I change my mind. In this regard, we are all Keynesian. Let me now elaborate on each of the three rules of travel. First, this journey is a fully warranted normalization, but not a tightening so far. Let us be humble. We were surprised by the inflationary surge last autumn. As late as October last year, core inflation was still 2% in the euro area. And the surprise was for everyone, on both sides of the Atlantic, and for both private and public forecasters, and yes, central bank projections. What did we miss? There was excessive reliance on inaccurate energy price futures, as the ECB recently acknowledged. But let me stress another element. We missed the intensity and the contagion of supply chain disruptions. And then came the war, awful, unexpected, incorporated as an energy shock, but probably understated again in supply chain disruptions in Europe. Regarding other key inputs, other than energy, think of aluminium, fertilizers, or neon. There is probably a general lesson from that. We need to continue complement macro modeling by more micro-listening to entrepreneurs. Entrepreneurs are not always right, but this time they were right earlier than us, and by the way, they are the real price and wage setters. Is surprise a polite euphemism for mistake? In forecasting, yes, but it was a very collective one. In policy, it is not, and this is a powerful foundation. Nobody seriously argues that past monetary policy or monetary aggregates are the main culprit for actual inflation in the euro area. Bottlenecks in construction or in the automotive industry can hardly be attributed to, say, excess liquidity. By now, it is crystal clear that our monetary policy cannot simply look through the ongoing supply side shocks. This would have been the textbook response if the shocks were purely transitory. But the original energy price shock has propagated. Let me say it this way. Inflation is not only higher, it's much broader. Core inflation in the euro area climbed to 3.5% in April, still far below the US core inflation rate of 6.5% in March, but well above our 2% target. The ECB is highly vigilant about second-round effects and wage developments, knowing that at times they can move quite abruptly. We also monitor inflation expectations closely, not only from market participants, but also from households and firms. There are signs, including in Banque de France business surveys, that these expectations are becoming less and less anchored at 2%. Against this backdrop, let me stress that we also need to carefully watch exchange rate developments. We don't have an exchange rate target, but the level of the euro matters significantly for imported inflation. A euro that is too weak would go against our price stability objective. I want to stress one further argument in favor of normalization. Even if inflation returns progressively to around 2% by 2024, which is our forecast and which remains my view, the present monetary accommodation will no longer be warranted. Strong unconventional measures, such as net asset purchases or negative interest rates, were necessary when inflation was too low for too long, but not as inflation comes back to our target, which will be good news. Normalization is fully warranted, but normalization does not imply tightening. Let me explain that. Words matter in central banking and in economic life, as it is about avoiding excess slowdown. We are still far away from monetary tightening, as real interest rates will remain significantly negative and below the neutral rate for some time. The neutral rate, R star, you all know that in this very distinguished audience, is a reference point at which inflation and economic growth does not accelerate further nor slow down. Using a metaphor, it's a moment when, while driving your car, you lift your foot from the accelerator pedal, as you approach the desired speed. Only when you actively push on the brakes would the action be considered as monetary tightening. Raising our interest rates from the exceptionally low level where they are now is reducing accommodation or normalization, not a monetary tightening. I will come back later to the lively debate about the precise level of R star. Let me add one important element on the side of normalization rather than tightening. We, and rightly so in the euro area, will maintain a significant size of our balance sheet through our policy of full reinvestment, and we set for PEP till at least the end of 2024. Here again is a significant difference with the quantitative tightening that the Fed, for instance, will start next month by shrinking actively its balance sheet. I come to my second rule of travel. The pace and the length of the journey will be guided by an active use of optionality and gradualism. Christine Lagarde has strongly advocated optionality, and so have I. Optionality means acting in due time according to the latest real data in a very uncertain period. Not being pre-committed is an absolute imperative. Avoid too long forward guidance, favor agility. But optionality, let me also insist on that, does not mean inaction or adopting a wait-and-see attitude. And I think the time has come for further clarity and action on the beginning of interest rate normalization. First, in the pre-announced order of our sequencing, we will stop net asset purchases and decide in our June meeting precisely when in Q3. I have seen, like you, much, perhaps too much, speculation, predictions, statements on that precise end date. Let me simply stress that seen from today, the case for continuing to press the accelerator and adding further net purchases after June is, say, not obvious. Then will come a more important decision on the timing of our first interest rate increase. We decided in March that the first hike would come sometime after the end of net purchases. Well, how much is sometime? We will decide it in June or later, but let me share two reflections this morning. According to my personal judgment, the three conditions of our forward guidance on interest rates are fulfilled, even if they provide a prerequisite for the liftoff without implying necessarily a mechanical and immediate decision. The most important condition, consistent with what I said about inflation becoming broader, is the third one. I quote, that realized progress in underlying inflation is sufficiently advanced to be consistent with inflation stabilizing at 2% over the medium term. Well, here we are, and let me show it. By all measures, underlying inflation is clearly above 2% at present. Second reflection, about the timing of the first hike. There have been many comments about the precise month of the liftoff. While I wouldn't preclude the next few governing council meetings, I would rather set a marker a bit further down the road. Barring unforeseen new shocks, I would think it reasonable to have entered positive territory by the end of this year. As the most obvious next step, rate increases towards zero may have dampened effects on growth, as bank margins and profitability might increase and might improve the ability of banks to provide credit, although the evidence here is far from clear-cut. One additional technical remark. As we raise the DFR, which is at present our key rate, the level of our two other rates, MRO, presently at 0, and MLF, will have to be increased at some stage to preserve a smooth functioning of the interbank market. I spoke about the start of the journey. It's becoming clearer, and then the attention is currently shifting more towards the end of the journey. The IMF, interestingly, suggested in its latest WEO last month that, I quote, central banks should communicate clearly their perspective on the post-pandemic neutral rate, giving markets some clarity on the likely endpoint for rate hikes, unquote. And true, our current forward guidance does not provide information on the path of nominal rates post-liftoff. The notion of gradualism introduced in our March meeting fills this gap to some extent. There are two traditional and strong arguments for gradualism. First, avoiding the economic and financial instability created by stop-and-go policies. Second, dealing with uncertainty in convergence with the other principle of optionality or with the famous Brainard principle of 1967. That said, research by the Banque de France shows that gradualism shouldn't mean excessive caution or inertia. If, in the case of persistent shocks, the central bank reacts too cautiously, inflation expectations are likely to increase, putting higher upward pressure on inflation. The bottom line is that the pace of normalization will have to be calibrated in order to reduce efficiently the uncertainty on future inflation. To calibrate the normalization of policy rates, we need to assess the monetary policy stance appropriately. And firstly, what is the correct horizon of real interest rates to measure the stance? Current levels of headline inflation are very high, leading to deeply negative ex-post short-term real interest rates. And we are all aware of this debate in the US. Larry Summers has noted that this deeply negative real interest rates goes against established rules to stabilize inflation. However, if we look at longer-term implied real rates, including expected inflation, there is less reason to be alarmed. You see it on this slide. The blue curve is incorporated the expected inflation in 1 year. While current inflation is quite high, inflation is expected to recede back to 2% at the same time as policy rates are expected to increase. Let me now come to the debate about the neutral rate. As I mentioned earlier, its level cannot be precisely determined ex ante. However, current estimate of real neutral rates point to level between -1 and 0% in the euro area and between 0 and +1% in the US. Such neutral real rate gap across the Atlantic can be largely explained through less dynamic demographics and potential growth in the euro area. Given an inflation target of 2% on both sides of the Atlantic, this suggests a nominal short-term neutral rate, possibly between 1 and 2% in the euro area and between 2 and 3% in the US. These values seem indeed consistent, as you will see it, with financial market-based interest rate expectations. Look at short-term rates on the left part of the panel, or look at the nominal terminal rates of about 1.5% in the euro area and 2.5% in the US on the right part, as proxied for the OIS with a maturity of 1 year in 9 years. But, having put these considerations on the table, let me stress a but. We will have to be pragmatic along the way. When short-term nominal rates in the euro area approach such a range, we will have to judge whether or not this is sufficient according to the inflation outlook at that time. If this seems compatible with a stabilized inflation outlook of 2% over the medium term, then we can say that we are close to the end of our normalization journey. If not, we should have to pass over this neutral rate zone, which means that a tightening of the stance would then, and only then, be necessary. Let me now come to the third and last rule of travel. The journey should prevent unwarranted fragmentation among travelers. And this is our specificity as a monetary union. I would like to elaborate on a third principle put forward by our governing council. I spoke about optionality, gradualism, and now flexibility. In a widely remarked speech in Jackson Hole 12 years ago, 2010, Jean-Claude Trichet set out the idea of a separation principle distinguishing stance and transmission of monetary policy. I quote him, "The monetary policy stance is always designed to deliver price stability in a medium and longer-term perspective. The non-standard measures have a clear purpose, ensuring that the standard measures themselves are transmitted, I stress the word, are transmitted as effectively as possible, despite the otherwise abnormal functioning of some markets," unquote. This separation was afterwards less relevant in an environment of too low inflation for too long, in which non-standard measures contributed importantly also to providing monetary policy stance to close the inflation gap. Indeed, the PEP and TLTRO III had both stance and transmission effects. But here we are again close to a separation principle. During the normalization phase, we are prepared to confront two possible risks for transmission. First, liquidity shortfalls in the banking sector in some jurisdictions. They can be addressed anytime by longer-term refinancing operations. This is why I propose new LTROs. Second, and more important, unwarranted market fragmentation in public or private bond markets or specific asset classes, such as, remember, commercial paper in March 2020, could happen. I stress here the unwarranted fragmentation. As regards all the lasting consequences of the pandemic, we are ready, we said it from last December very clearly, we are ready to be flexible in PEP reinvestments or even to resume its targeted net purchases if necessary. But our commitment against unwarranted fragmentation is broader than the consequences of the pandemic. As Christine Lagarde strongly said in the last press conference in April, I quote the President, "We need to continue to integrate flexibility in our monetary policy determination, if warranted, and if necessary, we can move very promptly. To be determined in our commitment, we don't need to be specific about technicalities, the precise design of a new instrument, or the conditions which would trigger appropriate interventions. We can at any time draw the positive lessons from the PEP flexibility efficiently used in 2020. Everybody should be aware that we have in our toolbox this contingent backstop. Preventing fragmentation belongs to succeeding in normalization. In order to avoid any influence on the stance, an option worth considering would be to sterilize flexible asset purchases, that is, to absorb the liquidity injected through adequate liquidity offsetting operations, as it was practiced under the Securities Market Program, SMP, until 2014. Other innovative design options would include selling a particular asset sometimes after its purchase, once the market stress episode has disappeared. And regarding the stock of assets, let me reiterate the point that we should maintain the size of our balance sheet for an extended period of time. This will ensure, through reinvestment, a significant presence of the Eurosystem in markets, and also contribute to prevent fragmentation or too brutal adjustments in the term premium. Note, however, that the coexistence of a large balance sheet and hence significant excess liquidity and positive ECB rates will raise new technical issues about banks' reserve remuneration. I have no doubt we will solve them in due time. But I already said many things about our roadmap, so let me put aside this technical question for the next future. And let me conclude. While the first part of the journey towards policy normalization, namely the exit from asset purchase program, is almost concluded, it is time, this is what I elaborated upon this morning, it is time to provide a possible roadmap on the next part of the journey, including the possible endpoint. I am confident that the three rules of travel I propose today, beyond the technical content, will enable us to fulfill our commitment towards our fellow citizens. Let me say it simply this way for the wider public of 340 million Europeans. You can trust us, your central bank, to ensure price stability and bring inflation back firmly and durably to 2%. We have the duty to act. We have the will to act. And we have decisively the capacity to act. Thank you for your attention.
I'm not sure if I have to press anything. No? Perfect. It works. Thank you very much for these very interesting remarks. And I thought that being the designated moderator, I might ask you the first couple of questions and then perhaps opening it up to the audience. So the question that I have is with regard to inflation. You mentioned that the supply chain disruption was the prime or is the prime element in explaining inflation in Europe. We heard recently in the US that it is also an issue of elevated demand, so that it's not just the supply chain, but it's also a quote-unquote overheated demand situation. We know that in both cases we have a very tight labor market, at least that's been depicted as such. To what extent do you see the major difference between the two? That's number one. And the other question is, if it is really, if we missed collectively the inflationary pressures, had we known, let's say, that the supply chains would have been much deeper, if you will, in terms of disruption, would central banks in general acted earlier?
Can you hear me? It works? Yes. First on inflation, to be still more precise in my wording, I didn't say that supply chain as a prime element. It's an important element. Obviously, another one is energy shock. And here there was a very collective mistake, which was an excessive reliance on futures. And the ECB paper is excellent on that. So I stress, I don't know if it's a second, a parallel, another element. Then your questions about the US situation and the differences with the euro area. You are right, and thank you for giving me the opportunity to give some light on that, because I didn't do it in my statement. Here, the economic situation is different. There is an excess of demand in the US. We could discuss its origin. We all know that the size of the fiscal package was larger in the US than in Europe. There is not an excess of demand in Europe. There is a tight labor market, full employment in the US. There is a less tight labor market in Europe. I don't say that it's not tight at all. We still have a significant unemployment rate in several countries, more than 7% in France, still more in Italy or Spain. Despite that, many companies, including in these countries, have difficulties to hire people. So it's tight, but it's more a problem of mismatch, perhaps, between qualifications on labor supply and labor demand. But there is less pressure, including on wages. So these are two macroeconomic differences which are significant. It doesn't mean, as I advocated this morning, that we can look through the shock. I am convinced that normalization of monetary policy is fully warranted. Could you repeat your second question, because as a good central banker, I tried not to answer it, but...
I will repeat it then.
No, had we known it, would we have acted differently? It's always difficult to say. So I will probably say that bygones are bygones. We are in the world as it is, but...
Right, right. In a way, I'm just wondering to what extent you have here a situation whereby it would have been difficult to talk about normalization of monetary policy earlier, given this shock of, let's say, the supply shock, given the, and we'll talk later on in terms of, the impact of the pandemic. We've had these series of shocks here that have derailed the inflation situation to some extent, or intensified the supply chain issue. And to what extent, then, could a central bank have acted sooner?
Let me try to answer more seriously to your good question. I don't think it's a question of explanation, justification, understanding by the public. We are independent. Sometimes we have to make difficult decisions. But I think we should not forget the simple and awful truth of the Ukrainian war. If you look at what happened, there were two shocks, obviously. And the first one, the first surge in inflation, we saw it last fall. And then we saw the first supply chain disruptions. But if you look at our economic forecast, and it was fully warranted at the start of this year, let us take January, 4 months ago, we were confident. We had significant growth expectations. If I take this country where you are in, France, it's very spectacular. We had a 7% growth last year, more than the euro area average, 5.4%. And we expected this year to have a growth of about 4%, more than our forecast of last fall. So the recovery was really impressive. The recovery had as a consequence supply chain disruptions. And here we underestimated this difficulty everywhere. But we were confident, with good reasons, especially including from business expectations themselves, that these supply chain disruptions would fade away, let's say, during this year, before the end of this year. When you ask French businesses, and it's the same for all European businesses, they were living through supply chain disruptions, and they said it very clearly, loud and clear. But they were expecting, and we put the question to them, how long will it last? And the vast majority answered less than 12 months. And this was also a good justification not to overreact in monetary policy. And then came the second shock, the war, which, with its effect on supply chain disruption. So this is the way I would put the question. Unfortunately, supply chain the energy shock was increased significantly, and supply chain disruptions are here to last more. I don't know how long. And as I said, due to that, inflation is not only becoming higher, this was the effect of the energy shock, but it's becoming broader. This is the effect of supply chain disruptions.
I have many more questions, but I will not be just this egocentric, so I will open it up to the audience. We have a few minutes, is that okay? And I see a question up there from Julian.
And the mic is coming. If you can only introduce yourself, it will be my pleasure.
Of course. This is Julian Galhau from Rokos Capital. So I would like to thank you first for your speech. I think that was very interesting, particularly your observations about the need to avoid defragmentation going further forward, and your observations about the neutral interest rate, it has become, I think, very clear for the financial markets that the Fed is setting out its terminal rate, and the ECB has been less transparent on this point. So I think your comments to that and the potential circumstance in which you might go to restrictive territory are very, very interesting. I would like to ask you a little bit more, if you might wish to elaborate, concerning your comment that interest rate increases, or the so-called lift-off, could be at one of the next few meetings, if I heard you correctly. I mention this in the context where, as you're probably aware, there is quite a flurry of comments from different governors, ECB board members over the last few days concerning that date of liftoff, with, for example, Isabel Schnabel talking about saying possibly July, Mr. Panetta of the board also speaking, Mr. Wren yesterday talking about July, and then Mr. Holtzman appearing to suggest June. My inference from your speech is that you yourself think that the timing of liftoff could be as early as June, given your observation about how inflation expectations are rising, particularly among households and businesses, such as from your Banque de France survey, and such as other surveys like the Bundesbank survey. So I wonder if you might be able to comment on this particular point, i.e. Whether a liftoff could come as early as June. Thank you.
First, thank you for your thanks. I do appreciate. Let me stress again that we will see what will be the governing council decisions. These are my personal view, but it was important to share them with you this morning. Second, about your question about the precise timing of the liftoff. As you noticed, listening to me carefully, I didn't say anything. So I won't quote the famous sentence by Alan Greenspan, which is, by the way, completely overhauled. This was about old-fashioned central banking. We have to be more transparent. But I gave some indications about the end of APP. About the liftoff, frankly, all this discussion about should it be late June, July, August, September is a bit excessive. What I did is to give a marker further down the road. And I think it's important to have a broader view of this normalization journey. It's why I said that barring new unforeseen shocks, I would think it reasonable that we have entered positive territory by the end of this year. And about the timing, we will see in our next governing councils. This also belongs to optionality. We will look at the data. So I hope, a more interested direction, while not being that precise about the end date, but each of us can make its prediction.
Thank you. Paul, you have a question?
There was a question.
And where? Okay.
Thank you for your very clear remarks and spelling out ECB policy in very clear terms. You referred to the R-star rates in the EU, the Eurozone, and the US. I'm wondering, underlying those approximations of the neutral rate, what are your assumptions about potential GDP growth in the Eurozone? And I'm thinking of demographics and productivity.
And there is another question up there, a lady. It's hard to see with regard to the...
I thought you had a question, but I was wrong. Could we have the mic here?
take my chance and I ask my question. Olivier de Boisson from Société Générale. Thank you very much for your exposé. My understanding is that your view of policy normalization does not include a reduction of the balance sheet. So my question is very straightforward. What would be, in your view, the conditions for policy normalization that would include a reduction of the balance sheet of the central bank?
Sorry, so I will try to answer quickly these two questions. First, your important point about potential growth and R***. First, let me use this opportunity to stress another element about the level of R***. As we all know, we could spend the whole day discussing about the level of R***, and as Jean-Paul rightly reminded 2 days ago on Wednesday, nobody can observe R**. So I quoted ranges. In the important elements for the level of R**, I quoted potential growth, I will come back to it, I quoted demographics. There is also an important element about inequalities. And there is very interesting research and converging about that for a very simple reason. Wealthy people or high income tend to save more. So higher inequality leads to higher R**. And it's also one of the explanations why it's higher in the US than in Europe. Coming to your point about potential growth, estimating potential growth is almost as difficult as estimating R**. And by the way, I am always a bit fascinated when you look at economic assessments of structural deficits, because they depend upon potential growth, how much they vary. When you look at the estimation of the output gap, how it can shift in the time. And so all figures for potential growth are changing, to say the least. Having said that, it's a very useful indication or range. I would quote some figures for France, and the UR average is quite close, probably. Potential growth has decreased significantly in the last 3 decades from more than 2%, I would have said between 2 and 2.5, to less than 1.5. It's not only a European trend, it's a general trend in advanced economies. Due to the factor you mentioned, which is a decrease in productivity growth, in productivity increase, deceleration of productivity. Then comes the question why. Obviously, the demographic is less favorable. We have an increase of the labor force, which is smaller. This part, we understand it well. But now we still have this question, why don't we have more effects of technological innovation and digitalization in IT? You know the famous Gordon paradox. I belong to those with Banque de France work, which are, by the way, Banque de France is strongly focusing on productivity with very interesting skills and analysis. I belong to those who think we could see a reversal of productivity. And that the IT productivity gains or the digital productivity gains are ahead of us. Think of home working, think of the general diffusion of digital use of e-commerce, etc. Think also of the acceleration of innovation. So I would be in the cautiously optimistic camp on this side. But at present, the answer is below 1.5% for potential growth. On your question on the side of the balance sheet, First, what we said is clear in our monetary policy statement last December, that for PEP at least, which is a significant part of our balance sheet, we expected to fully reinvest till at least the end of 24. For APP, it's a bit less precise. We said for an extended period of time after the liftoff. My view is that it's an important part of our normalization at present, for all the reasons I gave, including maintaining a significant presence on the market. I expect the discussion of balance sheet normalization will only start once our journey toward policy normalization is well advanced, and the runoff will be then quite mechanical. But Kathleen, we will see if we have time in between to organize another GIC conference.
That's a great exit, isn't it? Unfortunately, time is against us. It's time for moving on, but thank you ever so much. Please join me to thank the governor for his remarks. This was really quite interesting and enlightening. Thank you so much.